I'm John Batchelor. Larry Kudlow, my colleague and co-host, is here. CNBC and Kudlow Radio on the weekend. And we're very pleased to have Sudeep Reddy, the economics editor at the Wall Street Journal, who, with his colleague, John Hilsenrath, tomorrow afternoon, the 15th of June, will be making a video. We'll be on video to talk about the FOMC meeting, the Federal Reserve meeting, and what the meeting means, where we are for the Federal Reserve rates, for the short-term rates, and also for the direction the Federal Reserve sees for the remaining of this election year. However, tonight we have Sudeep to give us a preview of the confusion everywhere in the world about the Federal Reserve. Sudeep, a very good evening to you. As I understand it, the bond market is saying, no, 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 do nothing, no, no, no. Is that correct? And why is the bond market so pleased to believe that the Federal Reserve will not move tomorrow? Good evening to you.
Good evening, John. It's very clear that the Fed has one mantra over everything else, and that is caution. It's been cautious since the financial crisis. It doesn't want to make any fast moves. Janet Yellen is an extremely cautious Fed chair. She doesn't want to make any sudden moves. And when you look around at the state of the economy, the number of political risks in the U.S., in Europe, all over the world, and just the general sorry state of the global economy, she does not want to be the one responsible for any kind of trigger that starts more problems than we have right now. So the message you will get from Janet Yellen out of her press conference is one of caution. She does not want to sound too downbeat, because we have had, until the last month, we had relatively good job growth. We have had decent but not great consumer spending. We have a number of other factors that are not disastrous. They're not great, but they're not disastrous. And so she doesn't want to create any of that fear just by talking. But she knows that it's not a pretty picture out there.
Well, I think, Sudeep, I basically agree with you. There's not going to be any rate hike tomorrow. I don't think there's going to be one in July, and I don't know. We'll see about September, but I doubt it. But just on the jobs numbers, a point I made earlier, if you smooth those numbers out on a 3-month moving average, we've seen a decline since last December. It's been 5 months of a steady decline, and the peak was about 280,000. Now it's down to about 110,000. So whatever statistical glitches and whatnot occurred in the May number, the pattern is clear. And I want to add one other thing on jobs. The Conference Board has an employment index. It's a leading index, and that thing's been falling for quite some time. And the Federal Reserve also has an overall employment index, which we don't hear much about anymore. But that thing's been falling for some time. And, I think profits declining, business softening, I don't think these are good omens at all.
They're not good omens, but if you look at where we are with job growth, if you had seen job growth over the last 6 months slow to maybe 100 or 150,000 a month on a more on a slope that was less sudden, you would have looked at it and said, hey, we're approaching full employment as an economy. We're getting closer to the point where there aren't as many jobs available. There are fewer people who are in the official unemployment numbers. The unemployment rate is below 5%. There are a lot of reasons it's below 5%. There are people who have dropped out. There's some bad problems there. But you wouldn't have been that startled by job growth that was a little bit slower than what we were seeing before. The problem now is that we've seen a sudden slowdown. And I remember back in 2007, we saw a sudden slowdown in September of 2007, just weeks into the global credit strains, and that was the early indicator of problems around the world, problems certainly in the U.S. credit markets and economy, and a few months later we had a recession. So nobody wants to make a sudden move now given that risk, but the odds are pretty good that this isn't necessarily an economy that's just delivering 30,000, 38,000 jobs a month. It's probably somewhere above that, but it's not a great trajectory.
Yeah, we were talking earlier about interest rates. I mean, low interest rates, I'm not talking about the overnight rate. I'm talking about medium to longer term rates, which really aren't affected much by central banking policy, particularly now the Fed's not buying directly. But, low interest rates, Sudeep, that can be a negative sign for the economy. I mean, real rates are negative on the 5-year, basically near zero on the 10-year. That's a bad sign, return on capital, economic growth. That's a sign of stagnation and near zero inflation. I mean, a healthy economy, I think, would have a 10-year rate of something like 4%, maybe 5%. That would be a healthy economy. We just don't have that, and it's not just here, it's around the world. So I think the falling interest rate message is very negative.
It is around the world, but on a relative basis, the U.S. is much better than many parts of the world. And so that matters. It's not good, but it does matter that the U.S. on a relative basis has somewhat higher interest rates than the other developed economies. Janet Yellen would much rather have America's problems than Japan's problems or Europe's problems.
I want to ask about the larger picture of rates. Larry was saying earlier that in Germany, for example, they're near zero. How does the United States look to in contrast with the European economy or the Asian economy? It used to be said that we were an island of a refuge. Is that still true, Sudeep?
We're a refuge in a way that the dollar is the reserve currency of the world. It's still the leading position, and the U.S. economy being better than a lot of developed markets is going to be the place where people come to park their money when interest rates are somewhat higher than in other parts. But Japan and much of Europe, they've got serious demographic problems. We've got demographic problems, but that's the difference between what's happening here and what's happening in, say, India or Nigeria or any other economies that are fast-growing emerging markets that you expect to have much better outlooks for the next few decades.
See, I think that if you want to look for solutions to this, and I always take an optimistic view these things can be turned around, I wouldn't look to the Fed. I wouldn't look to monetary policy. I think what ails the economy is more on the supply side, particularly business investment, and as I said earlier, declining profits. I think I think you need, as I've said many times before, you need major corporate tax cuts and you need major regulatory changes to unburden the economy. I just don't think the Fed has any power in this game right now. The Fed saved us in 2008 with a burst of liquidity, but I don't think we've had much impact since then. You could make a case the Fed could have raised rates in 2010 and 2011. We did have a temporary inflation rise, but really now, Sudeep, I just think it's fiscal blockage is what I call it, and I think the Fed should be sending out an SOS to Congress.
You could have said that for much of the last 8 years, that we've had fiscal blockages, we've had regulatory issues, we've had a lot of things. But it's not just us. We have, in Europe, they've got fiscal blockages. They've got an inability to have their elected political leaders do what's necessary, make hard, tough choices, because they're going to get clobbered in the polls. And so it's a problem of democratic systems where we're handing over the reins to unelected officials because they don't have to face voters at the polls.
Did Janet Yellen make a mistake in December, and did that undercut confidence in her leadership, Sudeep?
It's an important question of whether Janet Yellen, after leaving interest rates near zero since December 2008, should have left them near zero, right at zero, even longer. At some point, the Fed had to try to raise interest rates. At 5% unemployment, you're going to have interest rates near zero. You have to at least see what the effects are. Obviously, the effects haven't been great, but they haven't necessarily been disastrous. There are a lot of problems in financial markets that we've seen as a result of it, because it was something new, because they had become accustomed to zero interest rates. But I think eventually she'll be able to pull interest rates up a little bit more, but I'm skeptical she's going to be able to do an entire rate hike cycle, even to get interest rates to 3 or 4% on the federal funds rate before she's done and has to deal with another recession.
Sudeep Reddy with John Hilsenrath will be making an interactive video discussion following the Federal Reserve meeting on the 15th of June. That's tomorrow. Larry Kudlow, CNBC, and Kudlow Radio on the Weekend. I'm John Batchelor.